and future of investing.
Welcome, everyone. My name is Tom Steinley. I'm the Managing Director of Business Development at Lear. I'm joined by Jim Warner. For those of you that have been on these calls before, you know Jim is our host, our head of research, and co-portfolio manager. And this is our March 2026 market and strategy update. By the number of participants we have on the call, Jim, it's pretty obvious that there's a lot of people that want to hear what you have to say. This is certainly an interesting time to be an investor. The current market volatility could be caused by any number of factors. To navigate this environment requires a thoughtful, intentional, tactical investment management or portfolio management process. And honestly, this is the type of environment that we love and we shine. Given your background, Jim, as a former foreign affairs major focusing on the Middle East, I'm especially interested to hear your thoughts on the Iranian conflict and what possible long-term effects that might have on the market. There is a lot to talk about, so let's just jump right in. Just a reminder for those that have questions, please utilize the Q&A box at the bottom of your screen, and we encourage you to ask questions. That's what we're here for. So, Jim, with that, please.
Great. Thanks, Tom. And thanks, everybody, for joining me today. Let me share my screen. Okay. Well, that's booting up. So the topic that we're going to discuss, we're going to address all what we think are the key elements that are driving this market volatility. And then, of course, we'll talk a bit about how we're positioning our portfolios and their performance, which not to bury the lead, but it's great. So the title of this webinar is Navigating the Storm, Iran, Oil, the AI Scare, and Private Credit. And we're going to go through each one of those things. And I know you're probably going to have a bunch of questions. Well, let's start off with this image. Right now, as an investor, it really feels like we're Neo in the Matrix trying to dodge bullets. In particular, surging oil prices, the Iran conflict more generally, stagflation fears as a result of that, AI threats to business models, and private credit. We're going to touch on all of this today, but it's creating, and as we'll show you, it's pretty wild. If you look at just a chart of the S&P 500, it doesn't look like we're going through a lot of volatility, but underlying volatility is actually pretty remarkable. Now, as we mentioned last month and the month before, we were getting an inkling that this was happening. And so about 2 to 3 months ago, we started really trimming our big outperformers. In many cases, these were, Google, Micron, great AI stories that had really done quite well. Irene, the Bitcoin miner turned AI data center provider. We did some heavy trimming, and that basically, and we've continued to do this as well as take down some additional risk in light of what we see as a pretty chaotic moment in time for the markets. And so we have accumulated cash or short-term treasuries that are now basically, for global vigilance, our moderate risk strategy is now at about 20%, which the last spike you can see in this graph on the left was Liberation Day, where we, basically took a whole bunch of risk off. But we're pretty much there at this point. And on Tilt, our most aggressive strategy on the right, you can see that we've never had this much cash in our most aggressive strategy. We're at around 20%. We just deployed a little bit of it, and frankly, and it's fun. We'll talk about what we just bought towards the end of this presentation. But where we sit today is we have tons of dry powder to capitalize on this market volatility. And so we're waiting patiently. And we are starting to nibble at some things, but we'll go through kind of why we're being conservative here in the next few slides. So really the three drivers of the current market volatility, and I think we're all pretty aware of these, is obviously the Iran conflict, and in particular, oil. The AI scare and the private credit. I'll come back to those two. But on Iran specifically, um, obviously the biggest issue here from a global economic perspective is really the disruption of the oil shipments and liquefied natural gas shipments through the Strait of Hormuz. They represent generally 20% of total global supply. I'll show you a map here in a second, but basically you're talking about oil from Iraq, Kuwait, Bahrain, Qatar, and UAE. Big producers, and they can't get their ships through without risk of getting hit by a drone from Iran or a missile or a mine for that matter. So that disruption is very serious. We'll talk more about that. The AI scare, this has been a crazy thing to watch. Um, it a year ago or even 6 months ago, all AI trades were good. Now now the market's really worried about what AI is going to do to various different business models. And in particular, there's been a lot of panic selling in software. We'll talk about that. But it's even hit less obvious sectors like logistics and financials and real estate brokers, all on fears of job displacement and generally business model disruptions. And some of this we'll talk about is fair, and some of it is pretty silly. And so we're poking around at a number of ideas in that may get added to the portfolio. But this has been dubbed the SaaS apocalypse. And so, the iconic firm Salesforce.com is down like about 50% from its peak, which is crazy for such an iconic, large software firm. The IGV ETF, which tracks software names, is down 25% from its peak. So it's been pretty crazy in the software world, and we'll touch on that in a little bit as well in deeper detail. And then finally, we'll touch on private credit. Private credit, I'm not going to go too deep in it right this second, but basically it's a $2 trillion market that probably doesn't deserve to exist. But thanks to the tight regulations that came out on banks after the GFC, we now have this new industry of lenders that it appears may have gotten themselves into some deep water. So we'll touch on that as well. Let's spend a little bit more time on Iran because I know it's very much top of mind. So this map over here on the right is a maritime map. This is a live image. Well, this particular one, this site tracks where ships are in the Persian Gulf and in the Gulf of Oman. And you can see where the purple circle is. That's the Strait of Hormuz. It's only about 20 to 25 miles wide at that point basically between Iran and what is essentially UAE. And you can see that there's no traffic in it. Now there's some around it, and what you can actually see is a stockpile of ships just south of it, just moored, just anchored at sea, waiting for safe passage. And we've heard a lot coming out of the White House in the last, say, 24 to 48 hours about things they're going to try, whether it's Navy escorts to try to reopen the Strait of Hormuz. They're obviously targeting. There was reports yesterday that there are small Iranian boats laying mines, and so there's a targeting campaign on those. It's a mess. But let's just step back, big picture, and what is this Iran conflict all about? Well, the key benefits are very clear. This eliminates the number one state sponsor of global terrorism. It also prevents such a nation from having a nuclear capability, which they have said over and over again they would use on Israel. And so the elimination of all of their weapons, which apparently is happening, will guarantee Israel decades of safety, most likely. And then we get to the question of regime change. And while the administration has been pretty forthcoming saying that this isn't about regime change, I think at the end of the day, um, what you can defang the snake, but you can also take off the head of the snake, but a new snake will take its place. And so it appears with the election of the son of the Ayatollah to the highest leadership position in Iran, who, by the way, just lost his entire family to American and Israeli bombs, is likely not going to be cooperative with the West. I think it would be a much better situation if we did have a cooperative government there, but a lot is unknown. Obviously, the key risks are, any kinetic war is inherently risky and can lead to retaliation. And given the number of terrorist proxies that groups that Iran has, who knows where that retaliation could come from. And obviously, from an economic standpoint, the closure of the Strait of Hormuz really does trap a lot of oil. So while, there's been a lot of comments from the White House about how these hostilities will end soon, we don't know what that means in terms of the end game, and when it will occur. So lots of important questions still outstanding there. Now, obviously, the key risk with the closure of the Strait of Hormuz is what it does to oil prices. And you can see in this chart on the left that oil has spiked, and the little extra, the star is actually where we hit Monday morning. We had an intraday high of $119, and you probably have heard that we had a wild day on Monday where we actually had oil go from essentially 95 to 119, and then it closed below 90. And sort of oil remains right around those levels. Interestingly, though, and that's actually a pretty normal thing. We've seen oil spikes in the past, and so that's not entirely surprising. And I don't think we're going to see oil prices really decline until we know what the outcome is of the Strait of Hormuz. But also interesting here is what natural gas is doing on the right. And this is a US index that I took. You can see that it actually did spike this winter. That had nothing to do with the Iran conflict. That had everything to do with the incredibly big snap we had nationwide. But it really hasn't spiked at all since this Iran conflict started, now what, a week and a half ago. So, and a lot of that can be attributed to the fact that energy independence, particularly when it comes to natural gas, matters. And that's where the U.S. does stand to benefit stands to be in a better position, relatively speaking, than a lot of the rest of the world. Gasoline prices have also spiked. I'm sure all of you have seen this if you filled up your car recently. But the question is it sustainable? And also, will it, we talked a lot in previous heading into this year, while generally speaking, we were pretty positive on the economic backdrop because of a lot of the stimulus that was going to hit, and in particular, large tax refunds, which are starting to, hit and fill up consumers' wallets. But if that stimulus basically then just goes right into the pump to fill up your car, which enables you to get to work, that becomes a bit problematic for the economy. But again, it's really a question of just how long does the Strait of Hormuz stay closed? And to that end, we don't know. So we just have to wait and watch. And what is the relevance? Well, I already mentioned that 20% of the world's oil passes through the Strait of Hormuz. There are a couple of pipelines that can bypass that strait, but they are kind of structurally insufficient. And there's a Saudi pipeline that can take on about 5 million barrels a day. There's a UAE pipeline that can take on about 1.5 million, but you're still left with about 15 million barrels of oil per day that are trapped. And these are places, this is oil from Iraq, Kuwait, Qatar. And so you've probably heard that storage levels have gotten to be basically totally full. So you're starting to see reports of production getting shut in those countries. And frankly, that is going to cause a mess. And the restart of that production will take time. And so there will be less supply coming out of those countries, probably for the foreseeable future, even if the strait were to reopen tomorrow. So longer term, though, what could this mean? Eventually those impacted countries like Iraq would recover their production levels. But the other really interesting thing to consider is what the impact would be if you had, an Iran that was run by leadership that was pro-Western, let's just call it. And then a more pro-Western Venezuela. In other words, neither country would have the sanctions on them, which they have had for quite some time. These two countries together have 30% of the world's proven reserves. So they are a massive and an important part of the story. Um, I went through and did some analysis. I'm not going to go through all the rest of these bullets, but basically, incrementally, Iran and Venezuela, it could redirect theoretically 2 to 4 million barrels per day. It would principally go to Europe and Asia. That would be on top of what is the typical 102 million barrels per day demand globally for oil. So 2 to 4%. It could theoretically, with a lot of investment, expand that further. Um, so on the margin, it probably means that oil prices could head lower, but that we are, I think pretty far from that day. All right, so let's talk now about this AI scare that I referenced earlier. And really, it's about business model disruption. The fear is that, in particular, software companies could be eliminated. And this has caused the sector to drop 35%. This is a different index than, say, the IGV I referenced earlier. It's the S&P software sector index, but this had basically a 35% fall, peak to trough. We may have troughed. What's really interesting is to see the chart on the right. The next 12 months price to earnings ratio for the software sector has really collapsed. Back in 2021, that the sector was trading at 45, 50 times forward earnings. That corrected down to essentially the kind of a 30 to 35 times earnings. And now we're down all the way to, 20, 25. Which basically, if you remember back to, Finance 101, all a multiple really is essentially a terminal multiple in perpetuity. And so if the terminal multiple, if for example, software does go away, then your terminal value is zero, right? And so it's going to pull down the entire discount of all of the future cash flows. And so what you're basically seeing here is a panic. It's very difficult to know who the winners and losers are going to be. And that is going to be one of the key things that the market's going to try to figure out, and we're going to try to figure out over the next, I'd say, 6 to 12 months. There's also been, as I referred to earlier, other victims of AI and this AI scare, like IT services. I mean, stop and think about that for a second. Like Accenture or IBM, right? They spend a lot of time creating systems for large companies. Are they really going away? I mean, maybe some parts of their business, but it's kind of hard to envision that they totally go away. But meanwhile, they're getting priced as if they are. Real estate brokerage, that's a very relationship-driven business. Brokers like Schwab, they all collapsed the other day because some startup AI company created some financial planning AI-based software. I mean, so it's in some cases the reaction has been quite silly, but in other cases they make sense. And so it's really important that we, piece through this. Now, I forgot to mention this in a prior slide, but we really don't have any software exposure in our portfolios at this point. We own Microsoft, which of course is a software company, and has gotten very cheap. But that's pretty much it. And so, we have done a very good job, I think, of getting away from this software issue really over the last 6 months. Last year, we exited ServiceNow, we exited Salesforce. So we exited our cybersecurity name, cybersecurity names have also dropped on this AI scare. So we really don't have any exposure to this. And sitting with all the dry powder that we have, we can really we're in a very good position to kind of determine who we think the winners are and have a really nice, attractive entry point. All right, let's talk about private credit. So first of all, what is it? So the private credit market is basically emerged after the great financial crisis, when very tight regulations were placed on banks' ability to lend to riskier borrowers. So, specifically, so what basically happened was a lot of the big private equity shops, like Blackstone, KKR, those kinds of guys, put together private credit funds, and they went to their normal folks. They went to the pensions and the endowments, and they raised capital to go and lend to largely middle market businesses. Many of the businesses they lend to are have been bought out by another private equity firm, and they basically have had a heck. They've had an incredible run since then because banks really couldn't compete with them. So they have, so this industry has grown now to $2 trillion in size, and and we've seen this really kind of this evolution that I'll talk about in a minute into lending to areas of the market that normally banks would never lend to. And so the other thing I'd point out is that because the regulations were so tight on the banks related to these types of borrowers, effectively in the wisdom of Congress, what they did was they basically forced this $2 trillion into unregulated private credit firms. And that's dangerous, generally speaking. We want these things to be regulated, but they're not. Um, and so hundreds of billions of dollars. So as this has evolved, um, they've then turned to retail investors. And they said, hey, if this is such a great deal, why don't we start pitching it to retail investors as opposed to just institutional investors? And so then came a wave of interval funds. And I'll talk about the perils of interval funds here in a second. So this has been sort of this growing business, lots of capital getting raised. And where have they deployed it? Well, about the first place, one of the big places they deployed where they lent was to software companies. Yes, the kind that AI may disrupt. The ones that we just talked about have gotten hammered by the stock market. Many private credit funds have been lending to software, and in fact, software now comprises 26% of the leveraged loan index. And according to US Bank, about 25 billion of these loans are already trading below 80 cents on the dollar, right? If it's money good, it should be trading around 100 cents. This means that there's a discount being priced in. Now, again, 25 billion is, kind of a small amount. The total amount of software loans out there is roughly 400 billion. But these particular loans that are distressed, they're not distressed because of AI. They're distressed for other reasons. We haven't even seen the real true impact of AI to fundamentals. So there's still more to come. There's in addition another 30 to 40 billion dollars of loans to AI data centers. And there are some very specific cases, not many, but there's a growing number of cases that where data centers have been built. However, they don't have access to power from the grid. And this is causing some of the loans to default due to the lack of cash flow and an inability to pay interest. And so if you've probably heard about a private credit firm called Blue Owl. It's also publicly traded. And it has it has two data centers that have this problem. And it's gotten a lot of airtime. But that's not the only ones that are out there. And so we would expect there to be more credit default issues. UBS is now predicting that default rates will surge to 15% in private credit, generally speaking, driven by software and AI data center loans. And if that's true, that's just not good. And so the question that we're basically wrestling with is, what does that mean for the rest of the market? Now, it's not going to cause, in our view, a banking crisis. The banking system is relatively insulated because, as I said, these riskier loans were frankly uneconomic for banks to even participate in. There may be a little bit of exposure, but I don't expect it. I expect the banking system to be relatively insulated. But we are studying it really closely because some of these private credit funds are levered. And when you get leverage added to illiquid funds, you can have a margin, you can have margin calls. And margin calls means you got to sell anything that you have that is liquid. And that's how you get these like big whooshes in the stock market when basically firms that need money have to go to the most liquid place they can find it, and that's usually the stock market. So it's really important that we understand this issue and watch very closely for that kind of contagion. I mean, at this point we don't see it, but it's something that we have to pay a special amount of attention to. And in the meantime, redemption requests from these private credit funds are now surging as investors are starting to get the picture that they got to get their money out. So unlike the stocks that we talked about that have fallen due to the AI scare, where there really could be some interesting buys, long-term buys, we're not touching private credit with a 10-foot pole. And this really could be the first inning of a potentially bad credit cycle. And so we want to avoid exposure to that. Real quick, what is an interval fund? Now, we have spent so when we get new clients from time to time, they will come with an interval fund. And a very, very popular interval fund and a firm that issues a lot of them is called Cliffwater. And we spent some time with Cliffwater understanding that business and the structure of the security. So you can buy the security pretty easily, but you can't get out very easily. So why? So what's really going on here? Private credit fund takes your money, investor buys in, they go out, they make a loan. That loan is illiquid. They will get some interest payments back. They will get some principal payments back, and then they take those and they pay out these dividends. And they also pay out interest expense on whatever leverage they're using in the firm. Because you can get mismatches in the liquidity, they only permit investors to sell on just 4 days in the entire year. So, for example, yesterday was one such day where you could try to get out of one of these things. Now, what you do is you put it in order, just like you would for any sort of stock or mutual fund, into Schwab or Fidelity or wherever you are at. And then you wait and you hope that all of your shares in your order get filled because they may not. And so as a liquidating investor, you can actually get capped because there's a mismatch in this liquidity. So, and this can create a huge problem. Now, why did people do this in the first place? Why did advisors ever think this was a good idea to sell to their clients, or why did clients ever want this in the first place? Well, look at the table on the right. The table on the right is directly from Cliffwater's corporate lending interval fund, and it is the monthly returns. So I just snipped it right out. You can go find this fact sheet online. And one of the things that you will notice is that they have only had like 3 down months, technically really 2 down months since they started this thing in June of 2019. Well, let's see here. We had a global pandemic. We had the highest inflation on record since the 80s. We had the fastest increases in Fed funds rate in history. Oh yeah, and then we had Liberation Day and tariffs. And you're telling me you've only had essentially 2 down months? Now, that's insane. It doesn't make any sense. The leveraged loan index has had far more down months, and so what's the deal here? Well, part of it is how they do the valuation of the fund. Now, in my years ago, after the great financial crisis, I was at a hedge fund, and we had investments in leveraged loans. And one of the things that I had to do was build and develop a valuation committee. And this valuation committee had to go through every single position in the firm and value it. And when you get to leveraged loans fall either into category from an accounting perspective of a level 2 asset or a level 3 asset. A level 3 asset is like a totally illiquid position, which many of these leveraged loans are. The only way you can model it is if you mark it to model. And so what you're essentially doing is you're looking at a DCF or comps but primarily DCFs and saying, well, EBITDA looks like it's going to go up in this company. So, maybe we mark this loan up a point. Very subjective. A level two is, sometimes these loans trade. And a level two asset requires you to really go out and say you call up Goldman, you call up JP Morgan, you call up three desks, and you say, okay, if I wanted to sell this, loan, how much do you think I could sell it for? And they give you a quote and you take an average of the quotes. But it's not anything close to the, accuracy of a market value that a liquid stock gives you, right? So you see where I'm going with this. Don't trust these valuations. When you see a table that looks like this, which doesn't even pass the smell test, there's no way that you could actually only have basically 2 down months over the course of the last 6, 7 years. It doesn't make any sense. And so this should have been an obvious warning to everyone. And then throw in the fact that there's a limited amount of a limited ability to get out of these things. These things are really just toxic, completely toxic. And we have basically worked with every client that had one of these interval funds to get them out. And fortunately, we've gotten most everybody out. I think we might have one case that we're waiting on, but that just came in. But the reality is, we saw this coming a mile away and got our folks out of it. And we just thought it was just there are obvious warning signs here that apparently a lot of people missed. Okay, so let's talk about the market here. As you can see from these charts, they're pretty interesting, right? The S&P and the NASDAQ, despite all of the volatility and the drivers of that volatility that I just went through, are basically sitting within 5% of their all-time highs. And you say to yourself, well, how in the world could that possibly be? The underlying volatility is obviously quite high. And this is partly the reason why we've raised so much cash. It just doesn't look very good, even from a technical perspective. So we think there could be a leg lower, and we'd be happy if there was a leg lower because we're sitting with so much cash. So we're taking, as you can tell, a very disciplined approach. We'll be very patient in deploying this excess cash because we may get the market could pull back another 5%, could be 10. It really depends on the resolution of the Strait of Hormuz, which I think is very difficult to predict. And it's also pretty hard to figure out which business models are going to be impacted by AI and which ones won't. Some will be winners, some will be losers, but that's pretty tricky. And as I said, we think we're in the first inning of this private credit problem. And besides, as I'll show you here in a second, our strategies are outperforming. So there's really no gun to our head to aggressively deploy into this market. And again, one of the things that we've done, and if you've been following us for a while, you'll see a repeating pattern in the way we approach crises. The key is to try to be able to box the problem, which basically means, can I quantify what the impact is going to be? And it's very difficult, for example, to quantify the AI impact on certain businesses. It's also very difficult to quantify what the default rate is going to be of private credit. It's also very difficult to figure out what is the ultimate impact on the Strait of Hormuz, on the global economy, on the markets, if it stays closed for the next month or the next 6 months. Nobody knows. And so if you can't box the problem, you really have to avoid it. And that's the key. The other thing is, yes, there's probably some really interesting software names or some of these stocks have really gotten beaten up as a trade, but we're not traders. We're here to make long-term investments. And so if we find a really great stock, we're not just trying to play for a bounce. We're going to be playing for a longer-term holding. And at this point, we have yet to find one. So that all being said, if the Strait of Hormuz were to open up tomorrow, that could be a buy signal for a lot of the market. And so, look, the beautiful thing here for those of you who have been following us for a long time, is that we can change. We're tactical investors. If things get better, appreciably better, we will get more aggressive. You don't have to do a thing. All in all of our strategies, we'll dial up the equity allocation, we'll dial up the risk a bit. But at this point, we don't really see a massive need to do that. Um, so performance update. It wouldn't be one of these webinars now if I couldn't announce another award that we've received. And this one, we got Top Guns award for Tilt, Global Vigilance, and our conservative strategy. And really, frankly, it surprised us too, but we were named Manager of the Decade for our conservative strategy. And which I think in order to get that, first of all, you got to be around for 10 more, for 10 years, which a lot of firms aren't. A lot of strategies aren't. The second thing is you have to be one of the top performers, top 10 to be specific. And we actually came in number 6, I believe. But what I really think this is credit to is think about all of the crazy things that have happened in the last decade. To be able to navigate those, to consistently compound wealth for clients is testimony to how good our investment process is and how effective it is at dealing with periods of market volatility. So, like Tom alluded to in the beginning, we really like these types of periods um, because this is generally where we shine. So just to quickly go through performance, Global Vigilance is up 5% for the year. Obviously, we had it, which is far outperforming our benchmark and the S&P. Tilt is also up around 5%, and it's beating its benchmark by a lot, as well as the S&P. And then our conservative strategy is also up around 5% year to date. Again, beating all of those indices. And even our strategic income is up 4%. This is really our strategy that gets a bit more yield. It's not on every platform, but it's great for conservative investors that need a little bit more income, but they don't want to take the risk of owning a lot of high yield credit. So let me just touch lastly, and then we'll take questions. Thanks for your patience on our current themes. Not a lot of changes since the last month, but we did add a new one that we're calling tokenization. And one of the interesting things that's going on in the global financial system is the use of blockchain and the digitalization of currencies. And I'm not just talking Bitcoin. Specifically, we're talking stablecoin. Due to the legislation that was passed last year, stable coins are now acting like an alternative to money markets. So effectively, every stable coin has a dollar, an actual treasury bill dollar against it as collateral. So it, just like a money market, it doesn't appreciate in value. It also doesn't depreciate in value. So what is it's effectively a much more efficient way to move money around the world with basically instant settlement times. And it's a pretty remarkable thing. So we bought Circle, which is a recent IPO. It's the largest stablecoin provider in the United States, second in the world. And it got really beaten up, and we decided to take a position in that. So very excited about that theme. There's a few other interesting ways that we're looking at playing that theme, but that's a new one that's emerged. So Tom, let's stop there and see if folks have questions.
Excellent. Yeah, thanks, Jim. That was terrific. As always, great information. Let's see.
Don't be shy.
Yeah, please ask. Jim, for some unknown reason, I have lost
That's okay. I got it.
videos.
So one question that just came in is how are we outperforming so much this year? And I guess you could probably ask how did we outperform so much last year? And I think it's really a few things. And it really goes to our investment process. Number one is we're tactical. We don't have fire and forget portfolios. We move around the risk. We adjust it as we understand conditions and we see changing conditions. Um, the other thing is that we're really focused on the fundamentals and letting the fundamentals drive our decision making, not sentiment, not the narrative that's out there. We tend to be a bit contrarian in our views. So I'd point to those two things principally as what drives our outperformance.
Great, thanks. Um, Jim, what keeps you up at night? With all the things that are with all the things that are going on that are affecting the market, short term, long term, and the three major factors that you pointed to at the beginning of your presentation. What is it that is, the worst case scenario that keeps you up at night?
Well, a really prolonged shutdown of the Strait of Hormuz would be very, very bad. But I think at the end of the day, I'm not. I'm sleeping pretty well because we have so much cash and we're so defensively positioned. If anything, what would keep me up at night is if we went right back to risk on. We might lag the market for a few days. So to take an optimistic view, if the market were to just really turn around and start ripping again, we'd have to deploy our cash pretty quickly. So to that end, I mean, we're spending, most of our waking hours thinking about what we want to buy next.
Great. Yeah. What about inflation?
Yeah, this is an interesting one. We got CPI this morning, and it came in core CPI came in around 2.5%. If you were to look at a line, just a regular line graph of where we've come, it's the lowest reading we've had since, before the burst of inflation in 2021. So the trajectory of inflation is actually quite good. Um, I know there's been a lot of talk in the last few days about oil prices and energy prices skyrocketing. First of all, remember that the Fed doesn't actually put a whole lot of credence on energy prices, right? They look at core PCE, which excludes food and energy, because they are so volatile. So I wouldn't get all worked up about spiking oil prices because they could go right back down if the strait is opened again. So I'm not willing to really kind of change my views at this point on inflation. In general, like I've been saying for years now, what's going to continue to drag down inflation is housing. Housing prices are going lower in much of the country, and that's about 25% of the core CPI number. So if you have a big chunk of that number dragging down, consistently dragging down the headline number, you really have to have a lot of other inflation. And then here's the other thing. We have really not seen whether any real amount of goods inflation. We talked about that. We've talked about that a lot over the last, year. Remarkably, frankly, we were in deflation until the tariffs hit, and then it was slightly inflationary, but we're talking less than 0.5% type inflation on a year-over-year basis. So really what's been going on is you've had, kind of other services where you've seen some inflation. And for most of it has been the culprit has been housing. And now housing is going the other direction. So, my general view is that inflation is not an issue until it is, and we'll change our minds. But, right now I'm pretty sanguine on it, which also means that I don't really see a big move in interest rates either. We've had a little bit of move. It's really been the 10 years been trapped in a range around 4 to 4.2% for quite some time now. I don't really see a whole lot of reason why that's going to change. The Fed, they're meeting, this week. I don't expect any change there. I probably don't expect any change until the summer. Um, you know, uh, we did have a bad payroll print, but if you sort of look at like 3-month averages of payrolls, it doesn't look too bad. I mean, So I don't, there's really no, there's no like um, urgency in my view for the Fed to do anything. And so, and I don't think there's any appetite to do anything either from what we can tell. So, kind of more of the same is where I come out on that.
Yep, great. One more question. What about energy infrastructure? Looks like MLPs and Cheniere are up big this year.
Yeah, we love it. Um, Unfortunately, they didn't do so well last year, but they're doing great this year. You know, the one huge advantage that the United States has is access to cheap natural gas. Obviously, MLPs are the pipelines that ship it. There has been massive development of LNG exportation capabilities and capacity over the course of the last few years. And so you're starting to see the rest of the world buying American natural gas. And companies like LNG, Cheniere, that's their ticker, LNG, um, they are the largest exporter of them all. And we absolutely love these stocks. They have great, in the case of the MLPs, they have great dividend yields. In the case of Cheniere, they have 99% of their revenues contracted out for the next year or two. And they've got more capacity coming online with an incredible amount of global demand for it. So we love it. And it trades still really cheap. I can't even believe how cheap it is. So we're still very excited about that theme.
Great. Good. Well, thanks. We are now about
There's
45 minutes into it. Is
yeah,
there
there's just one other question I want to touch on that just hit.
okay?
Um, yeah, so there was news today um, that the IEA is going to release a massive amount of oil reserves. It will help. This commenter is absolutely correct. It will help. Certainly the sentiment. That said, what they're releasing is like 6 days of, oil demand. So it really comes back to what does happen to the Strait of Hormuz. If it's closed for 30 days, that's a big deal. But you're right. I mean, there's a lot of countries are talking about releasing their oil reserves. The Philippines did something overnight. Obviously, we have an SPR that could be tapped. Unfortunately, it's a lot lower than it should be because it was tapped by the Biden administration, but and hasn't been replenished. But yes, there's definitely some reserves that could help certainly alleviate some of the pain and mitigate the spike in the prices themselves. So good comment there.
Great. Excellent. Well, I think it's probably about time to wrap that up. That was an action packed hour filled with lots of great information. Thanks to everybody on the call. As always, feel free to reach out to Jim or me or anybody else on the Lear team if we can be of help. And have a great month, great early spring, and we'll see you in early April. Thanks, everybody.
Thanks, everyone.